Hello and welcome to Smart Money. Today, we're taking a closer look at investment opportunities in China. And to help navigate through that, joining us now, Andri Joubert. He's Chartered Financial Analyst at Investec Retail Structured Products. Andri, thanks so much for joining us today. And I'm going to jump straight into it. What opportunity are you seeing in the Chinese market right now? And is there fundamental support to that opportunity on a sustainable basis?
Thank you for having me. We do constantly look for opportunities in the market, and China has been a hot topic, especially with Trump coming back into power, if one can say, and maybe a bit of a contrarian view, not quite, but we do have quite a bit of fundamental research and indicators showing why China could be a great investment opportunity. But it's also not a economy that you want to take up lightly, and for that reason, the opportunity that exists is one where you can get exposure to that market, but with a degree of capital protection. So that's opportunity that we'll discuss today.
In that context then, and with that scene laid out, Investec's, of course, putting an option on the table, giving investors exposure to that opportunity, allowing them to capture this opportunity. It's a structured product that we're looking at, International Opportunities Limited. Run us through what exactly we're looking at here.
It's a quite a unique structure. Investec's been issuing and structuring these products for the last 23 years, and the sole purpose initially was to make sure that we never have a scenario where we would lose a client's capital. So when we start and we look at an opportunity in the market, we try and take as little risk as possible. No risk is impossible, but it's as little risk as possible, but yet still giving investors the opportunity to get equity-like upside returns. So this structure, International Opportunities Limited, is actually a share. The client buys a share, but the share is structured as a Guernsey company that's listed on the Bermuda Stock Exchange. So investors buy the share, and the share acts as a structured product. But for all intents and purposes, the client buys a share that he sees on his stockbroking account, or there's an ISIN number. You can log on to Google or Bloomberg and see a value, and there's a daily price and daily value. But this share is made up of three components. The one component is a equity option, and an equity option gives investors the opportunity to get upside to this CSI 300 index that's built into this product. And then there's a bond component that protects the client's capital, and then there's cash in the company that's basically available to pay out fees for the distributors and the directors of this Guernsey company, etc. So it's a structure within a share, and the structure is very simple. You protect the client's capital if the share is held until maturity. There's a defined term, and that's a 5-year term. And I'll go through the nuts and bolts at the moment, but just to take a step back, we've chosen the CSI 300 index, which is an index that's got 300 of mainland China's most liquid A-rated shares, and it's listed on the Shanghai and the Shenzhen stock exchange. So it's a very, very liquid index, well diversified. There's no sector that's got the power to eliminate the index. So very well diversified, but it's also very well priced. If you compare it to global markets, it's very well priced. China is very well priced, but also the index in itself is well priced to itself. So from a fundamental perspective, price earnings ratios is long-term price earnings ratio is about 18, and at the moment it's pricing at 16. So there's an opportunity. And then we're seeing the US pricing north of 22 price earnings on, for instance, the S&P, where this market is close to half that. So just relatively to the rest of the world, the US hitting all-time highs. And it's been a phenomenal 2-3 years, and with China not so much. And when you're able to get a market that operates and functions like a developed market, but that is priced very cheaply, that's where the opportunity is.
Yeah. And as you've alluded to, you've chosen the structure you have to mitigate some of the risk. Like you say, you can only mitigate, to a certain degree, though. So what are some of the associated risks with this investment product?
Yeah, so the product's got a credit link note embedded, and the credit link note references sub-debt of investment grade banks. So even though we've taken market risk out of the product, the client still faces the issuer's risk. So the bank that issues this credit link note. So for instance, if something had to go wrong with the bank, or there's a default event, or there's a run on the bank, any one of those serious events, a client's capital can be at risk. But it's important to note, these banks are higher rated than the South African government from a bond perspective. It's big names, Goldman Sachs, JP Morgan. Those are some of the names. We're not 100% sure which names yet, because we on trade date, which is on the 7th, just after the 7th of March, we choose the bank that provides us with the best pricing, but it will be an investment grade bank. And also the sub debt that these banks reference is also S&P A rated. So it's a risk that from a default probability perspective is very low, relatively low. It does give a client an opportunity to buy an emerging market powerhouse such as China, but with a degree of protection. It is important to note that the share needs to be held until maturity for that protection to be in place, because there's a daily price, and the daily price will be affected by the level of the market and interest rates and volatilities, etc. So if the client wants to be guaranteed of his protected part of his asset, which is 100% of his initial capital in US dollars, he needs to hold the share until maturity, and that's a 5-year term.
You highlighted one conditionality there. I mean, what are some of the other requirements, if any, for someone to invest in International Opportunities Limited? Are we looking at a minimum investment amount, for example?
Yes. So the minimum investment amount is about 10,000 US dollars, right? So it's not, it's less than 200,000 Rand. But it's important to note this share it forms part of an alternative investment asset class. So it's an asset you want to add to a portfolio to bring down your direct equity market exposure, bring in a degree of capital protection, give you equity-like returns to a more risky market. So even though the Chinese market is well priced, it's got risks, and there are headwinds in that market. But based on fundamental research and analysis, in that is the opportunity, right? It's important to note, like, China is the second largest economy in the world, behind the US. It's double, much bigger than India. If you add India and the UK together, it's almost the same size as China. So, we saw now recently in the news, as recent as yesterday, how there was limits placed on chips being exported from the US to China, and then they went on and they created their own technology with this new application that challenges ChatGPT, and within a day, the major markets sold off. The technology stock sold off quite aggressively, and in that, it just shows you how, even if you try and limit a powerhouse such as China, it doesn't mean they're going to stop. They just work around it, and it's super interesting times, and I think that is quite exciting. Buying this very interesting market that is relatively cheap, and you know what? If it all goes wrong in 5 years' time, you can press the reset button and you get your 100% of your capital in US dollars back if no credit event occurs.
Let's leave it there. Thanks so much, Andri, for having joined us and for those insights into, as you say, a market that needs to be in the spotlight right now, and opportunities that cannot be, or offering opportunities that cannot be missed. Let's leave it there for today. Of course, Andri Joubert is Chartered Financial Analyst at Investec Retail Structured Products.
Thank you.